Back in 2008, the entire global financial system was on the verge of just completely imploding. And right at the center of it all were two companies you've definitely heard of, but maybe don't fully get: Fannie Mae and Freddie Mac. So today, we're going to pull back the curtain and see how these two pillars of the American dream were, well, pretty much designed to fail from the start.
You know, there's this one quote that just perfectly nails the tragic irony of this whole story. The idea was to combine the best parts of government, banking, and Wall Street to help people buy homes. But as commentator David Frum pointed out, they kind of got the worst of all three. That one sentence, it tells you almost everything you need to know about what went so horribly wrong.
So that really leads us to the big question we're tackling here. How on earth did this happen? How did these two institutions, started with this really noble goal, become ground zero for a financial earthquake that shook the whole world? To figure that out, you have to look at their bizarre, and I mean bizarre, and fatally flawed design.
And that brings us right to our first section, the impossible promise. This is really the core of the problem. You could even call it the original sin of Fannie and Freddie. It's what made a total disaster almost a sure thing.
Okay, so what were these things exactly? Well, they were this strange hybrid creature called a government-sponsored enterprise, or GSE for short. Just try to wrap your head around this. They were for-profit companies, traded on the stock market with shareholders who wanted to make money and CEOs making millions. But they were also created by Congress with a public mission. This split personality, this public-private contradiction, is the absolute key to understanding the whole mess.
And this is where it gets really interesting. You see, they were playing this incredible double game. Officially, on every single legal document, it said in black and white that their debt was not backed by the US government. But then they turn around to Wall Street investors, with a wink and a nod, and basically say, "Come on, we all know the government would never really let us fail." And everybody on Wall Street believed it.
And that belief, that implicit guarantee, it was like a superpower. It meant investors were happy to lend them just enormous sums of money at interest rates almost as low as the US Treasury itself, which is like the safest investment on the planet. This was basically a giant hidden subsidy that created what economists call moral hazard. It's a fancy term for a simple idea. They could take all the risks they wanted because they knew deep down, if it all went wrong, you and I, the taxpayers, would be there to bail them out.
So, with this superpower in their back pocket, Fannie and Freddie didn't just get big. Oh no, they mutated into something else entirely. Let's move on and see how they became what some people called the Godzillas of finance.
By the time the crisis hit its peak, Fannie and Freddie either owned or guaranteed over $5 trillion in mortgages. Yeah, that's trillion with a T. Just to give you some scale, the entire US economy at the time was about $14 trillion. They weren't just big, they were giants on a scale the world had never seen before.
They just completely owned the US mortgage market. At their peak, their combined market share was over 41%. Think about that. Almost half of the entire American dream of owning a home was flowing through these two fundamentally broken companies.
But here's the number that should really scare you: their leverage. For every single $100 of mortgages they were insuring, they only held about 45 cents in capital to cover any potential losses. That's a leverage ratio of over 200 to 1. It's like trying to walk a tightrope across the Grand Canyon with no safety net while carrying the entire US economy on your back. It's just insane.
And you can see their crazy growth right here on this chart. See that dotted green line? That's Fannie and Freddie. And you can just watch it shoot up and totally take over the market. They got so huge, so woven into the fabric of every bank and every investor that they became, without a doubt, too big to fail. You couldn't just let them go under. It would have dragged the entire global financial system down with them.
So, their enormous size set the stage for the final, catastrophic act. Because, during the wild housing boom of the mid-2000s, Fannie and Freddie didn't act as a voice of reason. Nope, they jumped right in and led what you can only call a race to the bottom.
So here was the problem they faced. Wall Street banks were cooking up their own mortgage products, using way riskier loans, and the GSEs were losing business. At the exact same time, Congress was pushing them to lend more to meet affordable housing quotas. So what was their solution? They basically threw caution to the wind. They started buying up and guaranteeing billions and billions of dollars in these increasingly toxic, subprime loans, all in the name of profits and politics.
I mean, just look at the numbers here. In 2003, they bought around $103 billion worth of these risky mortgage-backed securities.
Okay, a lot, but watch this. Over the next 3 years, that number doubled to an average of $204 billion a year. Their slice of the entire risky mortgage pie quadrupled in just a few years. It was a feeding frenzy.
So they weren't just another player in the housing bubble. Their cheap government-backed money was the rocket fuel. By buying up all these junk loans, they sent a signal to the whole market that the party would never end, encouraging even more reckless lending all the way down the food chain.
And then, of course, the music stopped. The housing bubble burst, and all of a sudden, that implicit "don't worry about it" promise had to be paid for with very real money. This is the moment the guarantee came due.
As people started defaulting on those risky loans in droves, the losses just piled up at a mind-boggling speed. Remember that tiny 45-cent buffer for every $100 of risk? Yeah, that was vaporized almost overnight. The great irony is that for years, people worried they'd fail because of some complex interest rate bet. But in the end, it was just simple, brutal credit risk. The loans they bought were bad. Period.
So the U.S. Treasury had no choice but to step in. The initial bailout, funded by taxpayers to just keep their doors open, was over $148 billion. And trust me, that was only the down payment. The final bill would end up being way, way higher, making it one of the costliest bailouts in American history.
This chart right here really shows you the scale of the emergency. To stop a complete financial apocalypse, the Federal Reserve basically had to turn on the money hose, buying up more than $1.4 trillion of Fannie and Freddie's bad debt. That huge spike you see there? That's the U.S. government making that implicit guarantee brutally explicit and becoming the buyer of last resort for the entire mortgage industry. So, after the smoke cleared and the trillions were spent, what did we actually learn from this whole catastrophe? Let's get to our final section and look at the lessons we can take from the wreckage.
So, what are the big takeaways here? Well, first, any system where private companies get to keep all the profits, but taxpayers have to eat all the losses, is a recipe for disaster. Second, these implicit government guarantees, they're not clever loopholes, they're just a massive incentive for companies to behave recklessly. And third, we learned the painful lesson that when companies get too big to fail, they can basically hold the entire economy hostage. At the end of the day, the business model for Fannie and Freddie wasn't just flawed, it was, from day one, guaranteed to fail.
And all of that leaves us with one final and kinda unsettling question. We know now that this specific model was a ticking time bomb. But the idea of an implicit guarantee, well, that didn't die in 2008. So when we look at our financial system today, we really have to ask ourselves, what other guarantees might be hiding out there in plain sight, just waiting for the next crisis to show up?